Imagine 1997. Apple teetered on the brink of bankruptcy, worth just $6 billion. The tech giant was on the verge of extinction, a stark contrast to its peak value of over $2 trillion today. In a desperate move, Apple brought in Steve Jobs, who had been ousted from his own company years prior. Jobs saw chaos and decay, but also potential. He slashed unnecessary projects, reintroduced the iconic iMac, and revolutionized digital music with the iPod. In 2001, Apple released the iPhone, turning smartphones into devices we can't live without. The lesson? Even when on the brink of collapse, greatness can be reborn. Follow for more. Check bio for recommended business books. Picture this, 1997. Apple, once a tech titan, teetered on the edge of bankruptcy with just $62 million in cash. Fast forward 4 years, Apple's market value surpassed $100 billion, marking a monumental comeback. The villain? Poor management decisions and dwindling sales under Steve Jobs' absence. The twist? His return in 1997 brought innovation like the iMac, iPod, iPhone, and iPad, revolutionizing personal computing, music, mobile phones, and tablets. But here's the lesson. Never underestimate the power of leadership and innovative thinking. Follow for more. Business books linked in bio. Picture this, 2021. Byju'S, India's most valuable edtech startup, valued at $22 billion. Fast forward, just 2 years later in 2023, the company teeters on the brink of bankruptcy. The fall began with aggressive expansion and excessive spending, promising growth but delivering debt. The market for online learning saturated, competition intensified, and Byju'S struggled to maintain profits. Lack of financial discipline, coupled with a misguided attempt to enter new markets without proper research, compounded the crisis. The villain? Ambition unchecked by caution. The lesson? Success can be fleeting if not managed carefully. Balance growth with sustainability, and know when to pause and reassess strategies. Follow for more. Check bio for recommended business books. Most people never hear the real story of FTX collapsed. The numbers involved will shock you. One decision changed everything. The biggest companies in the world still make this exact mistake. The lesson is simple, but almost nobody applies it. Follow for more. Check bio for recommended business books. Imagine 2005. MySpace ruled with over 75 million users. Fast forward to 2006. Facebook emerged, and in just 18 months, it outnumbered MySpace's user base by a staggering 40%. Picture this. Facebook started with zero ad revenue compared to MySpace's $350 million. Yet, the game changer was Facebook's focus on user experience and data privacy. MySpace neglected these, making it easy for users to switch. Lesson learned. Prioritize user experience and data security. It's not just about being first, but offering a better service that users trust. Follow for more. Business books linked in bio. In 1984, Nike's future hung by a thread. Sales plummeted 50%. The company was on the brink of collapse. But then, picture this. A University of North Carolina basketball player named Michael Jordan signed with them. Nike bet big, launching the Air Jordan line. A risky move as it defied NBA rules for off-brand shoe endorsements. Michael was banned for a game, and Nike faced a $5,000 fine for each infraction. Yet, Nike stood firm. They saw potential in this partnership, and the gamble paid off. The Air Jordan I became an instant hit, selling millions. Nike's revenue skyrocketed 200%, saving the company from certain doom. The Air Jordan wasn't just a shoe. It was a symbol of defiance and success. Lesson: don't shy away from taking risks. Follow for more. Check bio for recommended business books. In 2007, Apple unveiled iPhone, kickstarting the smartphone revolution. But imagine this. In 2011, Nokia held a staggering 40% global market share. Yet, they failed to capitalize on their lead. In a crucial mistake, Nokia chose Windows Phone over Android or iOS, limiting app availability and user experience. While Apple and Samsung innovated, Nokia stumbled. By 2014, their market share plummeted to a dismal 3%. The lesson? Embrace change, innovate swiftly, and never underestimate the competition. Follow for more. Check bio for recommended business books. Picture this. August 2018. India's infrastructure giant, Il&Fs, with assets worth $15 billion, suddenly halted debt payments. The surprise was as massive as a tsunami sweeping the financial markets. A tale of hubris and mismanagement unfolds. Over-leveraging, poor governance, and a web of complex investments left Il&Fs on the brink of collapse. A warning sign had been there for years. The company's debt rose from 90 billion rupees in 2008 to over 900 billion in 2018. Yet, nobody saw it coming. The crisis exposed the fragility of India's corporate sector and the need for stricter regulations. It was a lesson in the perils of unchecked growth and the importance of transparency. Follow for more. Check bio for recommended business books. Picture this, 1996. Marvel Comics, a titan of the industry, declared bankruptcy. A shocking turn for the company that created Spider-Man, Iron Man, and the Avengers. But imagine if you could predict their resurgence. In 2009, Marvel sold its film rights to various studios, leaving its cinematic universe fragmented. The villain here? A divided narrative that diluted brand value. Fast forward to 2008, Marvel made a bold move. They focused on their own movie studio, producing Iron Man with Robert Downey Jr., generating $585 million worldwide. This was the turning point. The success of Iron Man paved the way for an interconnected universe, building anticipation and critical acclaim for each new release. By 2009, Marvel Studios was born. The mistake? Selling off movie rights a decade prior. Follow for more. Check bio for recommended business books. Picture this, 2019, Wework, valued at a staggering $47 billion. But imagine, just months later, it's on the brink of collapse, leaving investors with massive losses. The villain? Ambitious growth, bloated expenses, and mismanagement. Wework leased office spaces by the hundreds, promising long-term agreements but filling them with short-term tenants. This strategy led to overcommitment, huge monthly lease payments, and a widening chasm between income and costs. The twist? The IPO revealed Wework's staggering losses, forcing the company to abandon its plans and accept a bailout from SoftBank. The lesson? Ambition without prudence can lead to ruin. Follow for more. Check bio for recommended business books. Picture this. In 2017, Toys R Us, a $12 billion empire, filed for bankruptcy. Simultaneously, Amazon's toy sales skyrocketed to $6.5 billion. Why? Imagine a behemoth, ignoring the digital revolution. While Amazon embraced it, offering convenience, competitive pricing, and global reach, Toys R Us clung to brick-and-mortar stores, unable to adapt to changing consumer habits. The lesson is clear. Survival demands adaptability. In a digitally driven world, businesses must evolve or risk extinction. Stay tuned for more insights on navigating the modern market. Follow for more. Check bio for recommended business books. Picture this. India, a country with the highest number of engineering graduates globally. Yet, it's one of the largest importers of technology. Why? Imagine, every year, over 1 million engineers step into the workforce, yet struggle to find domestic tech jobs. This skills gap leaves them no choice but to seek opportunities abroad or in multinational companies within India. The villain here is not lack of talent, but outdated education systems and an industry disconnect. With just 3% of engineering graduates employable, the question isn't why India imports technology, but why it exports such a surplus of engineers ill-equipped for the tech industry. The lesson? Investment in vocational training and collaboration between academia and tech giants could bridge this gap. For more insights on India's tech landscape, stay tuned. Follow for more. Check bio for recommended business books. In 1998, a $1 million investment in a promising startup named Google was made. Picture this. Just days before launching Google.com, a typo changed everything. Instead of Google.com, an intern registered google.com.co. The Colombian government claimed the domain, and Google faced a legal battle to secure their name. Time was running out. The stakes were high, with $1 million on the line. But in the face of adversity, Larry Page and Sergey Brin refused to give up. They fought relentlessly, eventually winning back their domain name. The lesson? A simple typo could have derailed one of the world's most influential tech companies. Always double-check your work, for mistakes can cost more than just time. They can threaten the success of your venture. Follow for more. Check bio for recommended business books. In 1819, a British trader named Sir Thomas Raffles found a humble fishing village. Picture this: 746 residents, 180 fish traps, and a bustling trade of spices and tin. Fast forward today, Singapore is the world's richest city with over 5.6 million people. How did this transformation occur? The villain was scarcity. With limited land and resources, Singapore had to innovate. They built a modern port, attracted foreign investment, and cultivated a business-friendly environment. The key mistake? Overlooking Singapore's potential. Many dismissed it as too small for significant growth. But the British saw its strategic location and rich natural resources. They turned Singapore into a trading hub, connecting East and West. The twist? Singapore's prosperity was not due to oil or precious metals, but its people. Follow for more. Check bio for recommended business books.